The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. In today's evolving financial landscape, corporate bonds have emerged as a critical investment avenue, offering yields that often outpace government debt while reflecting the health and strategies of individual companies. As economic conditions stabilize and central banks maintain steady interest rates, investor attention is increasingly shifting toward corporate bonds, particularly amid dynamic market trends in both developed and emerging markets. So what are the real-world movements shaping the corporate bond market in 2025? What risks should investors take note of? Well, to find out more, joining me now is Henry Low, Head of Asia Credit on the Asian Fixed Income team at Aberdeen. Henry, welcome back to the show.
Hi, Hongbin. Thanks for having me back on.
Thank you so much for joining us. Well, Henry, with government bonds offering low yields and currencies being volatile, corporate bonds often attract investors seeking better returns. So what factors are currently driving investor interest in corporate bonds compared to government bonds or currencies?
Yeah, I think you've really hit on the nail on the head, right? We're in this period now where interest rates have been stable, if not heading lower, and corporate bonds continue to perform very well in that market. Fundamentals are strong, and we're now seeing a market where in the last 1 or 2 years, corporate bonds have delivered almost 1% to 2% extra over the return that we're getting from government bonds across the world. That's certainly drawing a lot of investor attention across the board. One of the things we're also seeing, of course, is that money market yields are starting to trend down. And so people are looking for ways to reinvest that money or capture high yields in that market. And certainly corporate bonds tick many of those boxes as well. Maybe one additional factor is that there are thematic objectives that many investors have, whether it's capturing a specific type of industry or sector, or whether it's geography, or whether it's something like sustainability. Corporate bonds also lend themselves very well to that kind of outcome.
So what trends are you seeing in corporate bond issuance volumes and maturities in 2025?
So it's a range, and I would say there is some bifurcation between what we're seeing in developed markets and in emerging markets. In developed markets, the primary bond market has been very much alive. We've seen a lot of issuance from across the board, very much issuers looking to diversify their funding, term out maturities. Whereas in emerging markets, bond issuance has been a bit more muted, a bit more tempered. And Asia, in particular, has been affected by this. Not in a bad way, I would say. Certainly less bond supply is good for bond pricing on the whole. We've seen bond prices in Asia, and bonds in Asia generally do very well, have been one of the best performing markets over the last 2 or 3 years. But certainly where that has gone to is instead of issuing in US dollars, we are seeing a lot of issuance in local currency, whether it's Sing dollar, whether it's Indian rupee, Indonesian rupiah as well. Those local currency bond markets have pretty much taken up the slack. And we've seen a very positive development in terms of the liquidity and the depth of these bond markets, and certainly investor demand of these markets as well.
Okay. I mean, recently corporate bond spreads have tightened amid stable economic growth and a Goldilocks environment. So how sustainable do you think this trend is, and what could cause spreads to widen again?
In short, with spreads where they are today, the probability of bond spreads moving wider is actually relatively high. And that's a function of the fact that we have still geopolitical risks in the market. You can't discount the factor of a Trump headline. You can't discount the factor of a weakening U.S. economy and just broad geopolitical headlines. But I think the more important question is, if spreads do widen, will they stay wide? And I don't think there's very much a reason for that, particularly here in Asia. What we're seeing is a region of not only stable and strong economic growth, but we also have a region where the stability of institutions is really something that shines through amid some of the global and regional political uncertainties that we're seeing. And this has created a much less volatile operating environment for many of the bond issuers in our market. Fundamentals, corporate balance sheets remain quite resilient in this time and across the region. A lot of worry, a lot of concern about exposure to the U.S. export market. And if you look at corporate bond issuers in Asia, not that many actually have that material and exposure to U.S. And where they do, they often have U.S.-based or U.S.-focused manufacturing capacity. So that certainly tempers a lot of the risk. In that environment where you've got stable macroeconomic factors, you've got strong fundamentals, and also you've got declining US dollar bond issuance or net supply, a lot of that Goldilocks scenario is not expected to go away very quickly, I think, in Asia. And so we don't really see a scenario where if spreads widen, they continue to remain wide. And in fact, April is a good example of this. where spreads widened within the month, we were back to where we were, and in fact, we're now through those levels again.
And central bank policies, especially interest rates, heavily influence bond yields and demand. With the Fed holding rates steady once again, I mean, there is always this concern about inflation and economic slowdown. So how are corporates managing their debt maturities and refinancing risks in today's bond market?
In a word, I would say proactively. That's probably the best word to describe it all. If we break down the market into investment-grade issuers and high-yield issuers, in the former, there are no shortage of financing channels for investment-grade issuers. So it's really a matter for them of optimizing their balance sheet, optimizing financing costs in this environment. What I mean by that is what they're looking to do is not only extend their debt maturities, term out the capital structures, but they're looking at across a range of options to do that. There is the bank financing market, there is the bond market. Increasingly, we hear talks of the private credit market also, not only within developed markets, but certainly within Asia as well. And of course, equity market coming back to life, that's another financing channel that is coming back online for issuers. So, a range of options for investment-grade issuers to really look to show up the strength of their, corporate balance sheets. For high-yield issuers, it's been slightly different. As you know, the high-yield market has not been the strongest necessarily in Asia, although we have seen a very steady rebound over the course of 2024 and 2025. And what they're doing now in this market is to make use of a very strong and a very conducive market environment to get ahead of bond maturities and speak early ahead of these maturities to bondholders and reduce liquidity stress. As I said, volatility still remains a factor, and they never know when that market will disappear from them. So this is a great time for them to be engaging bondholders. They're doing that, and what they're doing as a result of that is they're coming to the market with buybacks, with tenders, and printing a new bond on the back of that. And, this is very healthy in terms of ensuring their resilience in the medium to long run.
Okay. Well, other than central bank policies here, how are geopolitical tensions and global trade issues influencing corporate bond markets, particularly for multinational corporations? Investors
seem to be quite sanguine on this risk, I would say, if you're looking at the market. And there hasn't been a lot of concern about pricing these risks. And the reason for that, by and large, is if you look across many corporates where they have exposures, across various jurisdictions, there has been a lot of focus in terms of corporate strategy to diversify operations and to cater towards creating or generating a local solution or local manufacturing capacity in an answer to some of this tension and trade issues that you talk about. Now, implicitly, there are some costs aligned with that, right? There will be increased capital expenditure that will need to be funded to grow infrastructure, to develop, plants, factories across different countries. But there'll also be that element of, complying with regulatory issues, with rules and different jurisdictions as well. So there will be a near-term effect of higher costs, but by and large, we're seeing this handled quite well across the board. The other element is really that of more localized funding. We're not seeing necessarily issuers looking to fund just in one currency, which is historically the US dollars or euro market, to fund these types of expansion or projects. The opening up, as I said, of local currency bond market and local bank financing channels has been a big development, and we're seeing many corporations actually look to those markets to finance some of their needs.
Okay. I mean, liquidity concerns in corporate bonds surfaced during past market stress periods. So are there any other risks investors should be aware of when investing in corporate bonds today, especially in different sectors?
There are two or three that we're looking at. In particular, ultimately, at this point in time, headline risk is probably the top of all of them, whether that is a function of geopolitical tensions, whether that is a function of increased regulatory risk that we're seeing in areas like financial in India. We expect these headlines to continue, and as a result, these headlines will continue to prove to be a source of volatility, though not necessarily sustained volatility. And as a result of that, one of the ways we're approaching the market today is actually to adopt a more diversified strategy. In a world where spreads are not pricing in a lot of buffer for many of these risks, it doesn't pay necessarily to be heavily concentrated in any particular name, any particular geography, or any particular sector. Importantly, actually, is also to be exposed to a broad range of monetary and fiscal easing regimes across the world. And while you might have a world where the Fed is pausing or maybe has to think about interest rate policy, as it has done over the last 3 years. In Asia, it's been a very different regime where we've seen central banks in this region move ahead of the Fed, easing monetary policy. And that diversification of exposure certainly is a positive. The other is in terms of looking at credit risk and credit ratings across the board. Not all credit ratings are created the same. There is a tendency maybe to equate ratings of subordinated debt from investment-grade issuers with that of a senior debt of a high-yield issuer. And similarly, equating corporate and sovereign risk, same rating as being one and the same from a credit risk perspective. We think there's a benefit in being more nuanced here. See a lot more safety in being exposed to issuers who have that resilience, that robustness in their balance sheet and also in their fundamentals. It also reflects well in their access to financing more broadly. And so some of the ways we're taking credit risk today is not necessarily by taking very deeply high-yield companies, in that single B basket, particularly in an environment where that risk is not being priced as well today as it was 1 or 2 years ago, but instead finding high-yield risk subordination. What I mean by that is not necessarily taking senior paper from bond issuers, but rather subordinated paper, with the view that many of these issuers have the ability to refinance or call these bonds over time.
Great. Some great insights from you there. Thank you so much, Henry, for joining me today.
Thank you very much.
Thank you. That was Henry Lowe, head of Asia Credit on the Asian Fixed Income team at Aberdeen. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.